Your unique story, our global audience. Global One Media.
Hello, and welcome to our series of interviews with decision makers and senior leaders of companies across the board to help you, our viewers, make informed and intelligent investment decisions. I am Munir Barazi, your business analyst and host, and today I am very pleased to welcome Joe Ovsenek, the director of P2 Gold, an exploration company led by a successful management team advancing their projects in highly prospective areas such as British Columbia's Golden Triangle. The company is listed on the TSX Venture Exchange as PGLD and on the OTCQB as PGLDF. Hello, Joe. It's such a pleasure to have you with us today.
Hi, Munir. Good to see you.
So let's start with the big news. Congratulations on unveiling the highly encouraging preliminary economic assessment for your Gabbs project. And your initial press release contained numerous notable details. I would like to start with the first one. Your operation will involve an open pit heap leach process focusing predominantly on the extraction of oxide gold and copper mineral resources. Could you delve a bit deeper into this process and elaborate on its advantages, and also tell us a bit more about the expected output?
Sure. Look, in Nevada, the most common method of mining would be a open pit heap leach when we're looking at gold. So what's involved? Simple truck and shovel operation. So you have a big shovel. We have 90-ton trucks, the plan. And so you're open pits. So it's like you start digging and loading the trucks. And so you dig up the ore, get loaded on the truck, gets hauled over to a crusher. We have 3 stages of crushing: jaw crusher, cone crusher, high pressure grinding rollers. But in essence, what you're doing is you're taking the rock from as it's blasted and loaded on a truck in big chunks, and you take that and you run it through the 3 stages of crushing, and you come up with about half-inch size pieces of rock. That's what we're focused on here, getting it down to about half an inch. That rock is then conveyed over and put on a heap, which is essentially a pile of rock. So you dig it up, truck it over, run it through the crushers, convey it, put it on a heap, and then you sprinkle it with a diluted solution of cyanide. And what we do is that cyanide percolates down through the pile that you've put on the ground. It's collected. There's a nice lining system, so there's no leaks to the environment. It's collected, runs into a plant. First, we extract the copper, and then we extract the gold, and then the solution is pumped back to the pad, and the process begins again. So it's a well tried and true process that's used throughout Nevada, and really does work. The big benefit of it: low cost. You can really keep your costs down with a heap leach operation. Production wise, we're looking at around, over the life of mine. Right now, there's an 11-year mine life projected based on what we're looking at right now. We believe there's plenty of room to make that mine life bigger. But at this point in time, based on what we've drilled off, there's 11-year mine life. We produce average about 50,000 ounces of gold a year and about 11 million pounds of copper. So, a nice small mine, generating good cash flow. And so that's what we're going to get with Gabbs.
Wonderful. And sounds like the economics of this project seem to be positive from the outset. So let's shift our focus a bit to the financial aspect. Could you tell us a bit more about the projected net present value of this project along with the internal rate of return?
Sure. Now, when we look at the net present value, the IRR, well, we're looking at set prices. Now, so what we did is our base case. We set as a base case price $19.50 gold, $4.50 copper, $4.50 copper, and per pound. Now, we set those prices based on what we see. We're about realistically, I think 2020, late 26, early 20, say early to mid 27, we should be in production. So what we're looking at with those prices is that's what we expect the price of a minimum price to be at the time we would go to build Gabbs. So a couple of years from now. Now, so on that basis, with those metal prices, We've got a nice, robust project, internal rate of return 16.7%, net present value at 5% discount rate, which is your typical discount rate for gold projects. You're in that $163 million. So a nice net present value. If you look at total revenue, net revenue to the company over that 11-year mine life, $1.5, $1.6 billion. So there's a lot of cash flowing. In fact, the net cash flow over that period is $320 million. So there's a lot of cash flow, which gives you lots of opportunity to do things with that cash flow. Return some to shareholders, use some of that cash flow to put back in the ground to expand the project, or maybe spend it on another project to bring that along towards production. So lots of cash flow, which is what we're looking for here at P2.
Sounds like a positive return on investment. So let's talk a bit more also about the cost. Could you tell us a bit more about the capital expenditure on this project, as well as the operational costs?
Yeah, good question, because when it comes down to it, costs are what drive the project. And so to start with, capital cost, cost to build the project, right now that's estimated at $230 million. That we're all in US dollars here. So $230 million. There includes a contingency of, nicely over $30 million. So actual cost built in that about $195 million, with a contingency of $35 million bucks built into the cost estimate, for things that come up along the way. Now, we feel that that's a nice conservative cost estimate. We believe we can actually get that cost estimate down. That's and actually build the mine for less. But as a first glance, looking at it conservatively, so $230 million on the capital cost to build it. Now, when we look at the operating costs, we look at that on a per ton processed basis, because that lets you know, okay, we're processing this many tons. It's gonna cost us this much per ton, and each ton we process is worth this much money. So it gives you a feel for how much are you making on each ton of rock you move. So our processing costs are roughly at this stage about $20 a ton. Again, we believe we can bring those down a bit, sharpen the pencils there a bit, but roughly $20 per ton. So that includes the blasting the rock, shoveling the rock in the trucks, hauling it, crushing it, conveying it, heap leaching it, and producing the copper and gold to sell. So about $20 a ton. The rock on average over the life of mine is about $60 a ton. So we're looking at about $40 of profit per ton of rock moved. And when you're moving 90 ton, rock with 90-ton trucks, that adds up fast. And that's why we believe the project has a good, solid rate of return and will generate a fair bit of cash for P2 Gold.
Yeah, for sure. And during your economic assessment, you've also performed sensitivity analysis and considered different scenarios, I imagine. So can you give us a bit more detail about the worst case scenarios as well as the best case scenarios?
Yeah, you have to look at both things both ways. It's really true. So, personally, I think worst case scenario is our current market that we're in right now. And so part of the, when we put out our news release, we actually gave some spot prices back as of June 27th. And at the time, gold was at, I think, 19 an ounce. Copper was at, I think, 381 a pound. And so at that basis, the project still had a 13.6% rate of return and a net present value 5% discount of $115 million. And the reason, we believe those are pretty low end prices is because, interest rates are high. People are saying we're going into a recession. So gold, with interest rates high, gold's usually a little lower often. Copper, when you're going into a recession, less copper usage, so price of copper is down. So we think actually those numbers are quite conservative, but we did stress the project further. So at $1,800 gold, what we did is we took our base case, which is $1,950 gold and $450 copper. As I mentioned, that's where we see the price of the metals as we go to finance in a couple of years. But what we did is, to stress it, we took $150 off the gold price, 50 cents off the copper price. And so you swing it down to $1,800 gold, $4 copper. The project still has, close to $100 million rate of return, 11.9% IRR. And in fact, we could push gold down to $1,750, $200, roughly $200 below where we are now. Drop copper down to, 375, 376, roughly, well, around where we are right now in copper price as well. So, really stressing those metal prices, and the project still has a double-digit rate of return. So we think this is a good, solid project. And as as I mentioned earlier in some other, when we were talking about some other questions, we can bring that capital cost down. And the more we do to bring the capital cost down, the better that rate of return and the better the net present value. Now, on the upside, well, everything above the base case of 1950 and 450 copper is gravy. So we stressed it $150 up on the gold price, 50 cents up per pound on the copper price. So $2,100 gold and $5 copper. And the project has a nice, well into the 20s, 21% IRR, 230, 240 million net present value at a 5% discount. And so what you'll find is, I think, just to put it, when you swing it, the project by 150 gold, 50 cents a pound copper, either way, what you're looking at is 140 million of revenue. So, so you can just, you can then do the math yourself and push it to higher prices or lower prices and see where the project will be. But that's essentially the steps there. So anyways, a little long-winded, but I like what I'm seeing. When we stress the project, still gives a solid rate of return, so we know we can weather the downs. So we're in a position to take advantage of the ups. And so that's what you want to be in this business.
Yeah, the numbers are encouraging, even when you look at pessimistic scenarios, as you highlighted. Are there other aspects of this project that you would like to highlight? And perhaps you could tell us about your next steps there.
Well, I think that actually fits in well together. So I'll jump into that. So next steps and things I'd like to highlight are like opportunities to, as I've talked about, lots of opportunities. So just to talk about some of them, one, the most common way to mine in Nevada, I think, especially on the size of mine that we have, is using a contract miner. And what that means is you hire somebody else to do the blasting and the shoveling of the rock and running it to the crusher. And so that's a contract miner. And the benefit of that is you don't have to pay for the capital. So right now, the way our preliminary economic assessment is lined up, there's about $45 million plus contingency. So it's almost $50 million of capital out of that 230 million. 50 million is associated with the mining equipment. So by using a contract miner, you don't pay for that. They pay for that, and then you pay them so many cents per ton of rock moved. And so we'll take a hard look at that, because if you can save that capital expenditure up front and spread it out over the life of mine, that really increases your rate of return on the project. So definitely look at that. That would be one of our priorities. Mine plan, that's just a simple one. This is a first look at the mine plan for a preliminary economic assessment. There are ways to change the mine plan to get a little more of the material mined up front, so that you improve that rate of return as well, also the net present value of the project. So we'll look at that. Expansion, there are potentially 4 to 5 million ounces of gold equivalent near surface at Gabbs. And right now we're only focused on about a million ounces of gold equivalent, say. And so lots of potential to expand and make this either a longer life or a bigger mine. So that's another aspect. CapEx, there's other things we can do to bring the capital costs down, looking at the different equipment to use, things like that. So those are some of the highlights. One thing I should mention as well is metallurgy. We believe right now we're saying 78%, 78.3% recovery for gold and 54% for copper. Now, when we ran our metallurgical tests, we ran them for 150 days. And at the end of that period, the recoveries were still increasing, but we had to cut it off at some point so we could finish the PEA. So by working on those, the process, maybe a little more cyanide up front, we believe we can actually increase those recoveries. So we're getting actually more dollars. So I said on average over the life of mine, we're about $60 a ton of rock. But we could actually increase that, we believe, by increasing the recoveries. And that goes straight to the bottom line. So all those things add up to make lots of opportunity. Gabbs is a great project, we feel, and those are just great opportunities to make it an even better project.
Yeah, for sure. There is a lot of untapped potential there, and you're leaving no stone unturned to increase efficiency on this project.
Absolutely.
My last question, what does all of this mean for shareholders, both current shareholders of B2Gold and those that are still on the fence?
Well, I think it shows, from my opinion, and I'm a big shareholder myself, a nice path to production and and what it shows is how undervalued the company is. If you look at the project at current metal prices, I think gold's about, last I checked, today's 1927, 1928 in that range, and copper is around 375, 380. On that basis, the project probably has a net present value 5% discount rate of 120 million US dollars. Our market cap currently is, I'd say, just about 10% of that. So you're getting a lot of value in our share price. If you own our shares today or buy our shares today, you're buying a piece of a project that has 10 times the value of what our shares are trading at. And that's just focused on the project as is today. So as we improve the project, that value goes up. And as we put it in production, you actually see a piece of cash that's, some of the cash from the project allocated to your share. So lots of value in our shares today. And as a shareholder, I'm very happy with the results of this preliminary economic assessment.
There's still a lot of upside potential for sure. Joe Ovsenek, Director of B2Gold, thank you so much for sharing all of those updates and insights with us today. We look forward to sharing more with our audience.
Thanks, Munir. A lot of future ahead of us. Thank you.